We have a very exciting provider of software and technology-enabled outsourced services into the life sciences sector, a company called Instem. Instem is really about helping drug companies bring their products to market quickly and safely. The group's been listed for nearly a decade. They've got their 10-year party coming up soon, I understand. And recent years have seen a very, very strong performance in the share price, bringing the group to a current market cap of around £60 million. Phil Reason, the CEO, is normally based in Philadelphia, but he's across this week in the UK talking mainly to institutional investors about Instem's H1 results, which were published earlier this week. You should have a note in your packs on the company from us. So we were delighted that Phil made himself available to us this evening. So I'll pass you over to Instem CEO, Phil Reason.
How many of you know something about the Instem story? Okay, a few. How many of you are Instem investors? A few. But most importantly, a small percentage who what a great opportunity with the rest of you. As Gareth said, I'm normally in Philadelphia. I'm over here 1 week a month. The business was founded in the UK. I joined the business, or a business called Instem, 37 years ago. I know you say that could be impossible based on how young you look. Although it was something called Instem, it was a business that was listed on the main market. The business that I'm CEO of today was the smallest division of three. That business did a public to private, funded by Alchemy Partners, who many of you will remember for some of the notorious things that Alchemy Partners were involved in. It was very successful for us. They became a 60% investor in Instem, then had an exit. And subsequently, as a business that has grown organically and acquisitively, we IPO'd to be able to access public market capital to advance our acquisition strategy. We've always generated enough cash to fund our organic growth, and that continues, and I'll be delighted to talk about both parts of the strategy. So although we have rejigged the order of this slide presentation a little bit, it's actually the slide deck that we are using for the Investor Roadshow. We often like to keep it consistent so you can see exactly what we're presenting to our institutional investors. There isn't much on our full year performance, but you will see that in the progressive note that's in your pack. More than happy to take questions related to that. So what is Instem? Instem is, as Gareth said, we're an IT provider to the life sciences. We have been providing solutions of this type for over 40 years. Instem, the name is 50 years old this year, and this part of Instem has been in existence since 1972. The area that we've always been involved in is the first one on here, study management. And what we're doing in that area is helping people manage a variety of types of laboratory activity. So it's studies in cell cultures, tissues, animals, and early phase clinical trials in humans. We stop at the end of those early phase clinical trials, and that's because there's a huge similarity, whilst the early phase clinics probably wouldn't like to talk about it in this way. Those early phase clinics where people go and they'll be residential for maybe a week to 3 or 4 weeks. It's actually the nurses, the clinicians, the doctors that are managing the study. They're recording all of the data. And really, those human volunteers are very much like a set of lab rats, where it's the facility that is managing that information. Because it's in that captive facility, you can interface an awful lot of the equipment, so simple equipment, scales and thermometers, or more complex equipment, blood pressure monitoring, or even ECG equipment, automatically into the system, so all of that data is collected manually. It doesn't have to be transcribed. When you get to late stage clinical trials and your volunteers are scattered all over the world, the software solutions are very different. It's actually a very competitive market with some very big players. So we have no aspirations to move into later stage clinical trials. The second area of the business is regulatory solutions. And this is all about getting data into the hands of the regulatory authorities. There's two components to this part of the business, which I'll mention a bit later on. A lot of this is during the R&D process, but there's an element of this business that is providing data to the regulators for marketed drugs, medical devices. And the third area of the business is informatics. By far the smallest. I'll talk more about this as we move on. However, and I'm sure you'll sense this when I talk about it, it's an area of the business that has us extremely excited if we think of the growth opportunities of the business. And, although it wasn't on our introductory slide, Gareth did allude to it, our goal is to help our clients deliver life-changing products to the world market. In this informatics area, we have huge opportunity to fundamentally change the process of drug research and development and help bring life-changing products to market more quickly and more affordably. Having been in business for a good number of years, having established a presence as a market leader in the vast majority of areas that we operate, as a global market leader. If we're not a market leader, then we are number 2 in the market. We've amassed a prestigious client base. It says over 500 clients on here. We've got a little bit lazy over time. That's well over 700 clients, but really does it matter much once you're over 500? We have all top 25 pharmaceutical companies. An awful lot of the study management work is today outsourced by pharma companies to the contract research organizations. So we have most of the largest contract research organizations as clients. We have a tremendous retention rate. 60% of our revenue we've reported in half one is recurring revenue from annual software support and maintenance or software as a service subscriptions. Our retention rate is regularly reported. We always do it at the full year. Sometimes we'll do it at the half year. We haven't done it in these half year results. It's always been over 95%, frequently over 98%. And that's really important because it's these same large set of clients that we can sell the rest of the portfolio to. And if you have clients exiting the recurring revenue things you've already sold them, you're also losing them as potential clients for the things you haven't yet sold them. We also have exceptionally high new business win rates. This is an industry that, whilst it's got more cost conscious over time, it has for decades invested in the best possible people, the best possible technologies. It's generally not hugely price sensitive. If you have the best products, the best services, then the clients will buy them. And as a consequence, we typically win, depending on the product and service, somewhere between 40 and 70% of all things we bid for. And that, in many cases, turns onto further ongoing recurring revenue. It's very much a global industry, as I'm sure you're all aware. And we've had a philosophy that, as a business that will this year have revenue of, if you look at Gareth's note, £25.7 million. We're a small business, but we have people everywhere that our clients do substantial R&D. So people in clearly North America, including myself. That's where 60% of the market is. It's actually where 60% of our revenue comes from. But we have significant presence in the UK. We have people in France, which, if the worst comes to the worst and there's a Brexit thing happens, that we still have a strong foothold in France, which will be great. But in growing areas, so China, we have a presence in China, we have a presence in Japan. And then actually, because it's got a great source of cost-effective talent, we have a huge team in India. And actually, that's now a growing opportunity as a market that we can sell into. So really, other than South America, that does very little work in this space, every other bit of the world is well covered. This is a really useful slide for us. We look at all sorts of market research data and have done over the years, and we've found that this annual report that comes out from Pharma Projects, it's publicly available, has the most predictive information related to Instem's success. So 2 elements to the chart. On the top right, This is the total number of drugs in the regulatory phases of the global R&D pipeline across all companies. When this is growing, then the pharma companies that share these drugs, and it's shared around a little over 4,000 pharma companies, have those 16,000 drugs. When they have lots of drugs in the pipeline, they need more of our solutions. There are more studies running. The CROs that do a lot of this work have more volume in their facilities. They need more users. They're generating more revenue. They spend more money on Instem solutions. The great thing is, over the last 5 or 6 years, there's been strong growth here, and that's been hugely positive for Instem. It's fair to say that there have been periods when it's been much flatter. The good thing with our business is the strength of our recurring revenue means that even when times are a little bit tricky for the pharma industry, maybe the CROs aren't full of business, our recurring revenues are a substantial amount. And even in those difficult times, what we saw is low to mid single digit revenue growth, but when things are stronger, we see considerably greater growth. The other thing that is important on this picture is where are these drugs in the R&D pipeline? Because Instem focuses on late discovery, preclinical, phase 1. And the growth in here is the most indicative thing about how much work is being done with the Instem solutions. Back here, there was a bit of a double whammy. Not only was there not a growth here in the number of drugs, but it was a period when pharma was needing to accelerate new products to market because they had drugs coming off patent, and their focus was on their drug candidates in these later phases so they could bring them to market. So the pharma companies were spending less with the preclinical CROs, and the preclinical CROs weren't buying as much new stuff from Instem. So really important picture. We present this every year. It's 6 months old now. Anecdotally, I was at an RW Baird Life Sciences conference last week and listening to the CEOs of the top half a dozen preclinical and clinical CROs talking about exactly these dynamics and how do they feel. Is this going to continue? Or are we just about to enter a period where pharma is investing less? And they were reassuring everybody that what they are seeing is this growth is continuing as far as they can see into the future. So a while spent on that, but this is the market fundamentals that underpins the Instem business. Just a little bit more granularity as to where our solutions sit. So this is a typical R&D timeline for a new drug. Sadly, it still takes something like 13 years from patent registration to bring a drug to market. This is the period over which today the pharma industry is spending about $2.56 billion for each new drug they bring to market, and it takes them 13 years. They have 7 years left of patent protection to recover all of that $2.56 billion and to make a profit. It's a risky venture. For those of you that invest in emerging drug companies, you'll be familiar with this dynamic. When they get it right, it's great. It's easy to burn a lot of money. The most compelling thing we can do for our clients is to change 13 years to 12 years and 51 weeks. Take a week out of that long development timeline, and our clients will realize for a blockbuster drug, $2 million of extra patent protected revenue for every day they have of extra patent protected revenue. So if we can take a week out with an investment that they make of $1 million, they will get a $14 million return on one blockbuster drug. So this is what the clients are pushing us to deliver. Yes, we can deliver operational efficiency. Yes, we can deliver better quality data that gives them greater confidence when they submit to the regulatory authorities. But at the end of the day, taking time out of the drug development. And this is a shared stakeholder vision. This is what brings new drugs to the patients of the world faster as well. So we're all aligned. Where Instem's product sits, so study management, we get involved in late discovery from about year 2 of this process through to the end of early phase clinical testing, which is year 7, year 8. But they're preclinical or non-clinical, those terms are used interchangeably. That animal-based testing carries on in parallel to human clinical trials. So our study management solutions carry on up until about here. We're not involved in phase 2 and 3 clinical trials, but we are involved in this non-clinical testing area that carries on. So for example, they're doing reproductive toxicology tests after they've allowed drugs into humans for the first time, because they won't be dosing pregnant women at the early stages of testing a drug on humans. They might be allowing a drug to be given to pregnant women once it's launched, so you need to do some reproductive toxicology testing in animals to make sure that's safe. Our regulatory solutions pick up utilizing data that comes out of our study management applications. They apply to data that comes right through this process. There are submissions to the FDA right through to the end that our regulatory solutions are helping with. And our informatics business utilizes data that comes from right across this continuum, not just up until when a drug is launched, but a huge amount of the data that we use here comes from clinical experience of what is happening with that drug in the market when it's launched. So those 3 areas: study management, generally the most mature, the least high growth top line revenue of our business, generates about 60% of our revenue, generates the vast majority of our recurring revenue, gives us a portfolio of highly satisfied clients that want to buy more from us. So hugely valuable to us, ticking over nicely. The area where we've been market leaders for many years, this is how people know Instem. Whilst predominantly today is to give you an overview of Instem as a whole, it was actually fantastic to see in our first half results that one of our longest standing, most mature products, it has 60% global market share, product called Provantis, has about 120 clients. We won 9 new clients in the first 6 months. That's a record by some way. We've probably never won more than 5 clients. We've won another 2 in quarter 3. For what we see as a relatively mature product with modest growth, there's still great opportunities to win new business. The other fantastic opportunity here is because these clients have been buying this software for many, many years, the way they bought it is they bought enterprise licenses, they installed it in their own data centers, and that's how most of them use it. Today, most software businesses provide their software as a service. It sits on our servers, people log into it, and we manage it all. About 80 of our 120 Provantis customers, for example, are deployed in their own premise. We have told them all this year that in a few years' time, the only way they will be able to get access to new releases of our software, which we make every 6 to 12 months, will be to move to software as a service deployment. We were convinced that the value proposition for doing that was compelling, but you're always a little nervous when you tell people that that's about to happen. You've got some conservative players in this space that might turn around and say, well, we want this software in-house. It was great to get no pushback. They understand. Many of them have already embraced this. A software as a service solution that we introduced about 12 years ago for small customers to make a sophisticated enterprise solution digestible by a small company. After 5 or 6 years of success, we started getting big pharma clients coming to us and saying, we've had a change of IT strategy corporately. We've been told that all of our enterprise systems need to move to SaaS deployment. And so the likes of AstraZeneca, Bristol Myers Squibb, Roche, top 10 pharma companies coming to us and saying, we want to use your SaaS environment. Great references to move the rest of the client base. Regulatory solutions. Over the last 4 or 5 years, the thing we have spent the most time talking to both our target market and institutional investors about. FDA-led standard called SEND, the standard for the exchange of non-clinical data. Until relatively recently, if you made a regulatory submission to the FDA for your animal studies to get permission to go take your drugs into humans for the first time, you would deliver to the FDA a pile of paper about the height of this ceiling, most of which is tabular data, And the PhD FD reviewer's first task was to start keying that data into the FDA system so they could do their analysis. Not the most efficient use of a PhD reviewer's time. The SEND standard was all about delivering that wide variety of complex data to an agreed standard, so it's all automatically imported at the FDA. Day one, they start reviewing, not rekeying. Instem was involved. That standard began about 12 years ago. There were two technology companies, Instem and another, a number of big pharma companies, a number of big CROs to develop the standard. It took until 2016 until the FDA mandated the first elements of that standard. For more esoteric study types, the standards group, many of the subsets of which Instem chairs, is still working on some of those esoteric study types. So not all data sets are yet being submitted electronically, but as of 2016, the first set were, and there's been subsequent mandates for higher volumes. What happens here is we have a technology platform that we've built that transforms the data from the form it was collected, however you collected it, puts it into the regulatory submission standard, and gives that back to the pharma company to send to the FDA. We, as a software business for many, many years, developed a technology platform to license to the clients to allow them to do this themselves. About 3 or 4 years ago, when we were selling this really hard, we said to clients, the way that's going to be most compelling for you to license this technology, you give us some data, we will put it through this software, we'll give you a data set back, you send it to the FDA. The FDA are testing their ability to receive and process these data sets ready for when the mandate kicks in. They will tell you how good a quality this data set is. They will tell you it is fantastic and you will license our technology. And that worked admirably, and we sold lots of technology. And then clients started saying to us, this is great. Can't we just keep sending you the data and you keep sending us high quality submission ready data sets back? And we scratched our heads for a while, looked at the market opportunity and recognized that this is a much bigger market opportunity than licensing the software. And that gave birth to Instem's technology-enabled services, and that is the highest growth area of what Instem's doing today. I won't talk through all the detail in this. We've been presenting information that's been showing the growth of our technology-enabled service business. Suffice it to say, revenue recognized H1 2017 and orders booked. So a couple of £100,000 in H1 of 2019, 2 years later, revenue recognized just over £2 million. We expect to recognize £4.7 million in this year. It is growing tremendously well. We frequently get asked questions about this. The only other picture I'll talk about is this. There is very reliable data on the number of studies that are submitted, or drug approvals, and as a consequence studies, to the FDA every year. It's also very clear of those study types what are now mandated. So you can actually say, well, how much time goes into each of these conversions? What will the industry need to spend to continue to make as many drug applications as they have historically made using the SEND standard? And that tells us that by the year 2021, the industry will be spending $120 million in services putting together these SEND submission data sets, growing from next to nothing in 2016 when the standard was first mandated. And today, this says in 2019, the industry will spend around $45 million. The dashed lines here say what of that total spend might be accessible for outsourcing to Instem, what will be done by the contract research organizations and pharmaceutical companies in-house that they won't even contemplate outsourcing. The potential accessible market in 2021, $60 million. Our hypothesis, our proposition was to say we should win at least 20% of that, $12 million at 60 million. As of today, we are winning over 50% of this market. The market is, we will represent this chart in 6 months' time when we do our full year results. The reality is The whole market is capacity constrained. Send is a very complicated standard. There aren't enough experts to keep up to date with things. The pharma companies are not submitting their drug applications as fast as they used to. This is not great news. It needs to get better. So my guess is it's going to take more like to 2022 or 2023 for the industry to catch up and to be spending at this sort of rate, $120 million. And for Instem, you know what, that's good news, because we are also capacity constrained. We are winning more business than we can undertake, no matter the fact that we're investing in a technology platform, we're adding people. And this is a land grab. If we do this work and we do it well, these companies will stay with us forever. If people, we're constrained and there's capacity elsewhere, and pharma clients strike up, or CROs strike up relationships with our competitors, we might have lost them forever. So the fact that it's growing a little bit slower is actually good news rather than bad news for us. Informatics, by far our smallest area of the business. We haven't published the results, but they're not price sensitive. So I can tell you that revenue in this area of the business was £280,000 in half one. That's up 47% from half one of last year. We expect that we will do 400,000 plus in half two. So that will be 40% growth in 6 months. We expect to see similar growth moving forward into 2020 and beyond. We are here leveraging a very sophisticated big data analytics and AI platform that came with a business we bought based in Cambridge, UK in 2011. It was the first business we bought post-IPO, and it's because we are long-term believers in the power of leveraging large volumes of data to improve pharma R&D. We changed the business model here from trying to license that technology to our customers to providing a technology-enabled outsourced service. The platform knowledge scan that we use is pretty agnostic to the use case it's applied to. What it understands is complex scientific concepts, diseases, molecules, tissues like organs and liver, species, all things that are very variable, interrelated. And it's why you see so many announcements of very capable big data analytics and IT AI businesses that announce their launch into healthcare and life sciences, and 2 or 3 years later, they announce their withdrawal because they're great in retail, in financial services, in areas where the data is not so complex. In this area, you need, and there are good technologies, not just Instem's. If you're going to invest in these sorts of technologies in this space, you need to invest in ones that are designed for this application area. However, we think it's also a failing proposition to sell something that will do all things for the pharma company. We believe you need to pick a very specific use case, and you need to build strong depth and leadership in a use case. And we've picked just one use case, target safety assessment. Its application is right at the beginning of the drug discovery process. It's when a pharma company has a belief that a biological target, if they can modulate that target, it will have a therapeutic benefit. So it might be a protein that's regularly expressed in the body, and that if they can increase the level of that protein expression, it will have a therapeutic benefit, or they could reduce the level of that protein. They may not yet know how they're going to do that. They might not have a molecule or even an idea of a molecule, and what they want to do is look at the world's knowledge. When people have modulated this protein, and that's often happening in research, that data is available and published, were there safety liabilities? Should we even bother trying to work out how to modulate this target? Because yes, it might have a therapeutic benefit, but it might get killed later down the expensive R&D process because there's a terrible safety liability. There might be safety liabilities that you can see, and they might be mitigatable. You might be able to give a companion drug that does something to address the safety implications you're seeing. It might be an indication where getting a rash is worthwhile if it's going to cure your cancer. All of that you can evaluate with huge amounts of data that's available publicly. And this is developing great momentum. Early days, but it is game-changing. So it's worth saying that revenue was up 11% in the first half. That's the run rate growth that's in the market for what we're going to do in the full year. It's nice to be on track. We are nicely profitable. We expect to be profitable in the full year. I am not going to talk to any of these slides, which I'm more than happy to talk more to you about, including the revenue mix and the important growth in recurring revenue and software as a service. But I will finish with the summary. We have fantastic opportunities for organic growth. We have done 5 acquisitions successfully since we IPO'd. We had a great cash performance in half one. We sit with around £6 million on the balance sheet. We have very supportive institutional investors who have provided small war chests ahead of time so that we could go and structure great deals with target acquisitions. For small deals today, we probably don't need to raise any money. We might use a little bit of debt. We are looking very hard to see if there are some really attractive, more transformational acquisitions, not just bolt-on acquisitions, because as we get bigger, some of those small ones, whilst very strategic, might not move the needle quite so much for the business. If we were to do that, then yes, maybe we'll be looking for additional equity fundraising. But until then, we can fund what we need to do organically and acquisitively ourselves. That's it. More than happy to take any questions.
Longer term, do you see the possibility that you would ever pay a dividend?
Yeah, so it's a really interesting one. We have a different spectrum of opinions from institutions, from those that like it and those that don't. I think we are more than likely over the next 2 or 3 years to be introducing a dividend. Not least, there are, particularly if we think at some point in the future wanting to do an equity fundraise, as our market cap gets bigger and we have greater appeal to a wider range of institutions, and as we think of private investors, there are a number of people, both private and institutional, that would just exclude us as a investment candidate unless we pay a dividend. So yes, we think it's worthwhile. It'd be great to get people's feedback. The general advice is it doesn't need to be massive, particularly if we're doing acquisitions and we've got other great uses of the capital, but it would be very helpful. So yes.
Yeah, because I noticed in looking at the projections that you get to a point of having net tangible assets fairly soon, hopefully, and that often is the key to being able to pay dividends.
Yes, absolutely.
Could I just ask you a technical question? Looking in the notes, you've got just over 15 million of gross cash, but have fully drawn the overdraft to 9 million.
Yeah.
And on the face of it, that appears very inefficient. Could you explain why, please?
Yeah, so that's a historic thing. Our bankers have long wanted us to do some corporate restructuring to actually collapse the structure and to move that so that we don't see a net deficit and a net positive, because the way they look at it is they are exposed to that entity. Although there's guarantees across the business, they would like to see it all tidied up. So would we. It is actually one of the things that we really need to do before we can pay a dividend. So there is an action plan in place to address that corporate structure that allows us to have that all in one net place rather than showing a net negative and a positive.
Could you quickly explain what that corporate structure is?
So it's looking at the intermediary businesses each time we've done a transaction. So when we did our public to private and with private equity funded, it introduced a new topco. That's a non-trading entity. We've then introduced Instem PLC when we IPO'd. That's introduced another topco, and it's collapsing those non-trading entities to get all of those cash balances in the right place.
I'm just looking at the numbers, like EBITDA margin of something like 10% or so. I mean, for a SaaS business in the healthcare space, that looks a bit low. Is that any reason why? Is it high capital intensity, or what is it? So
you're absolutely right. We're a leading business in what we do in the markets that we operate in, and top quartile life sciences IT businesses are delivering 25% EBITDA margins, and that's exactly where we believe we should be. One of the major factors there is a factor of scale and investment. So we have invested significantly over the last 10 to 12 years in that global infrastructure that allows us to market, sell, implement and support our clients all over the world. That's an expensive investment and undertaking, but it's very scalable. We could probably double our revenue and only add 10 or 15% to that general expense in sales, marketing, finance and admin. There is some cost of sale type implications for some of that growth, but the organization is highly leverable. So a big element of this is actually having growth organically and acquisitively that will leverage that really capable platform. And at 3 to 5 years' time, the target is 25% EBITDA margins. It's worth saying, as a £25 million business, and I didn't have it in this slide deck, our target is to be a £50 to £75 million revenue business in 3 to 5 years' time, organically and acquisitively. And as and when we achieve that, you can see where that operational gearing, operational leverage will come through and improve the margins.
You mentioned with the Send business, there is a lot of demand,
Yep.
but there's not enough capacity in the market.
Yep.
Could you please explain why is it that and why is it difficult to scale up that side of business?
Yeah, sure. So this is a really complicated standard. The data that we're pulling together is inherently complex. The relationships between the data is complex. We are working with data that is being collected. Maybe that data was collected 3 years ago or 4 years ago and is going to be part of a regulatory submission this year. And that data was collected before the standard was finalized. And it's not uncommon for clients to deliver us data. And we have to pick through that data and say, you know what, you're missing 5% of the data that you need to give us, that we will put through the transformation engine to give you a complete data set. You know, that can be quite tricky for the pharma companies. How do we work with them to work out where do you generate 5% extra data 3 years after you ran the study without the FDA saying, hold on a minute, you know, you can't falsify data or make up data. You've got to know where to find it in the organization. That needs people that are intimately familiar with how these studies are run, what the standard is. We call them Send experts. We have more Send experts than anyone else in the world. We've been gathering those Send experts whilst the Send Standards Consortium has been running. We have 7 of them. We need a little bit of Send expert time for every conversion we run. The challenge is finding more Send experts. They are like gold dust. There are many, many businesses chasing a very small supplier Send experts. You can't create them overnight. It's a bit of a conundrum. We have a next tier down that are Send professionals, people on their way to being Send experts. So, you know, some of the things that we're doing is how can we delegate more of the Send expert time to the Send professionals? How can we look at what automation the software provides and actually look at automation that liberates Send experts, not Send professionals, because it's Send experts that are in short supply. That's the problem. It's why it's affecting the whole industry, not just Instem. There just aren't enough of them.
Another follow-on question. You also mentioned you're looking for a transformative kind of acquisition, but there is not enough capacity in the Send side of business. How do you balance the two different initiatives?
Yeah, so great question. So acquisitions, you know, today we have 3 priority areas for acquisitions. An established business in the broad area that we collectively call, and the industry will recognize, of in silico R&D. It's where our informatics business sits. It's what we do with knowledge scan. It's what's growing very strongly. There are some well-developed predictive in silico models that are used. They're accepted by the FDA now instead of some animal and human-based studies. If we could add that type of business to Instem, change a business that's only going to do less than £1 million this year into something bigger, and be able to then help that push our huge opportunity with target safety assessment and knowledge scan, that would be a great acquisition. There are some competitors in the Send service space. They have 1 or 2 Send experts. It would make sense to acquire one of our direct Send competitors so we get some more Send experts, and we can, as a consequence, hire more Send professionals and hire more information scientists that are the other 2 levels. The last area is the clinical equivalent of Send. It's another standard, a horrible acronym, SDTM. Send and STTM follow the same structures. The way people produce SDTM data sets today to make a mandatory submission to the FDA is highly manual. It's not tech-enabled. Because it's a sister standard, our technology platform covers 70% approximately of what you need to do to create an SDTM data set. That is a market that is even bigger than Send. If we could acquire an SDTM services business that we could tech enable with our software, that would be a compelling acquisition. So one of them directly addresses potentially the Send resource deficit. Others would massively enhance two areas of the business that we see have got great growth.
Could you just speak about the competitive landscape in your business across different areas, and also looking at the market, how much of it is greenfield today and sort of insourced?
Yeah, so good question. Varies quite significantly across those three sectors: study management, regulatory solutions, and informatics. Because the data collection is a reasonably mature market where customers are on their second or third generation of products, we have sort of 2 or 3 typically competitors for each product line. They're generally businesses smaller than ours. There's only one instance I can think of in data collection where it's somebody bigger. We're winning probably 60-70% of new business. The competitors between them in most of those areas are sharing the rest. To the other extreme, in the Send outsourced services, we have CROs that have licensed our technology platform to do Send conversions for the studies they run for their customers. 1 or 2 of the CROs are starting to think about, we could sell Send conversion services for studies we don't run, and we'll compete directly for Instem. So there's a complete spectrum from IT businesses in study management to CROs at the other end.
Thank you very much, everybody. Phil Reason, thank you for your time. Thank you.